Well, if you look at real retail sales in the first 2 months of the year, they were only up 1% relative to the Q4 average. And if you look at discretionary retail sales, restaurant sales, purchases of building products, autos, they're actually all down on a 3-month basis. So consumer spending is slowing. Consumer confidence, which generally leads consumer spending, has declined a lot. Now, there's probably a tariff fear aspect to those numbers. I wouldn't take them literally. But certainly the fundamentals for the consumer, slowing income growth, rising delinquencies, the depletion of all those excess savings, that has occurred, and that's going to weigh on spending over the remainder of the year.
It's interesting that a fair few people that we've been speaking to have no delusions about the volatility to come, but they are hanging their hats on the markets to come back in the second half of the year, and they're predicating that on the deregulation premium coming back in, and that based on tax cuts, tax exemptions, tax extensions. Do you see it that way, Peter? And is that when we're going to see the unleashing of the animal spirits and corporate M&A and all will be well?
No, I think that's all wishful thinking. If the economy continues to slow, if unemployment starts to rise again, we're not going to get a lot of M&A. We're probably not even going to get a lot of policy support because the Fed can't cut rates very much because tariffs are going to push up inflation. And fiscal policy is also basically spend. You've got a budget deficit that's 7% of GDP. You can't really do a lot of fiscal stimulus in this environment, even if you wanted to. And this is important because the depth of recessions is not just a function of the degree of imbalances going into the recession. It's also a function of what policymakers do in response. And I fear that the response this time around is going to be very, very weak, which will lengthen and deepen the recession.
You know, Peter, this whole thing about the debt and the deficit, brings me to one of the scenarios under which you see there being upside for the market to get back to or to get to new highs. And that is if the bond market does not discipline the president over his plans to legislate more unfunded tax cuts. And this is sort of a roundabout way of saying that, there's upside to the market, could hit new highs if yields don't surge. But from everything that you've said so far, you sound, if I won't say pessimistic, but pretty bearish about things. So where do you see yields headed?
I think ultimately yields will go down because the Fed will be forced to cut rates much more aggressively than currently priced. But in the near term, I do worry about the upcoming budget negotiations. I do worry that President Trump will try to push through Congress even more unfunded tax cuts, no taxes on tips, overtime, Social Security, a lower domestic corporate tax rate, et cetera, et cetera. If that happens, the bond market may have no choice but to say no. And the way it's going to say no is by driving yields higher. So I wouldn't be aggressively buying bonds at the moment. I think that time will come, but we're not there yet.